Lemonade is using a lot of AI, it seems, in the delivery of the service. You're using it in natural language understanding and those chatbots. You're using it in machine vision and image recognition. When I look at the receipts, the risk management and risk assessments and sort of managing your overall portfolio. Lots of companies talk about doing AI. It's a bit like, teenage sex. Everyone's talking about it. Not many people are doing it. How important is it as a key technology within the Lemonade proposition?
I think it's central. You hear a pitch of a food delivery app, and it will include those buzzwords, machine learning and big data and everything else. And at the end of the day, they're delivering sushi, but they'll talk about how they manage their inventories and route selection and all that kind of stuff. Insurance in that sense is deeply different because our core product isn't sushi, and therefore the ability of machine learning and data to transform isn't limited to distribution and to back-end processes. Our core product is a probability theory. And probability theories are big time susceptible to data and to the number crunching power of machine learning. And this is really where it goes deeper than elsewhere. We use AI and data really throughout the process. We tend not to draw bright lines between different elements of what we're doing. We have bots that we use just for internal processes. So our customers will encounter Maya, our broker bot, if you like, who will sell insurance, and Jim, who pays claims. But internally, we use Cooper. And Cooper is a member of the team. You can chat to Cooper through Slack and ask him any number of questions. And he'll run a lot of processes. He'll run a big part of our DevOps operation, for example. So when a product manager wants to assign a new feature to developers, he or she will tell Cooper about this feature, who will assign it on. Cooper will then go to AWS and create a standalone sandbox environment and send the developer a link to the environment that Cooper's created. The developer will work on it and then inform Cooper when he or she has finished developing the feature. Cooper will then run 14,000 automated tests on the software before handing it off to a human QA specialist to sign off on it. And having got the signature back, Cooper will then push it to production. So Cooper is key to our R&D infrastructure, but Cooper also helps our regulatory teams. So we have to file regulatory filings in dozens of states on a quarterly basis. And if I need a loss report for a particular state for a particular time period, rather than rifling through the data myself, I just go into Slack and I type to Cooper, hey, give me a loss report from this date to this date for this state. And a second later, I have the report in a PDF format that I can submit to the regulators. And our underwriters use Cooper as well. So if an underwriter becomes aware that there's a severe weather situation or some other disaster that's going to afflict a certain zip code, and we don't want to be selling insurance while the fire is burning, he or she can go to Cooper and say, these are the zip codes that are affected, and for the next 24 hours, I don't want to be selling insurance in this place. And in fact, we've actually just replaced the underwriters in this regard because Cooper is now hooked up directly to NASA satellites and gets spectrometer imaging directly from the satellite of continental USA as it flies over several times a day. And it processes that imaging to identify fires. And then we'll look at the size and speed of the fire, and we'll create a safe distance from the fire automatically without humans even being involved. And when the terrible fires broke out in California recently, we saw them on our screens before we heard about it on the news. So we are seeing just about everything that we do, from customer support to underwriting to regulatory relations to development. Behind the scenes, the bots and the AI are helping us become super efficient. Insurance is the business of data. 20 years ago, if I asked you who are the bastions of the world's data and where are the best statisticians in the world, you'd have said insurance companies. Today, you'll say Silicon Valley, you'll say Google or Facebook or other places. And what we're trying to do is to bridge that gap. So to use the best practices of Silicon Valley to interact with customers in ways that is data rich, both in terms of the data that it generates and in the ways in which it can incorporate the learnings that are generated from that same data. If you sit in front of a broker, and in the US, the overwhelming majority of home insurance is sold through brokers. I think it's well north of 90%. If you're sitting in front of a broker, you are emitting signals all the time. Are you paying attention as I'm explaining the coverage, or are you not? Did you read that thing that I gave you to read, or did you not? Just as an example, those would be highly predictive of what kind of person you are and what kind of risk I'm underwriting here. But of course, they're lost. Mm-hmm. When you buy insurance with Lemonade, we ask you far fewer questions because we're able to extrapolate or use other data sources so we don't burden the process so much. But we'll collect something in the order of 100 times more data than a traditional insurance company will. Mm. So just in terms of data collection, every signal is captured. All of those digital breadcrumbs are hoovered up and analyzed, and we're finding them to be highly predictive of risk. So a lot of these things are really quite impactful.
A large part of the insurance industry, that social contract, has been dependent on us all agreeing to get into the lifeboat together. As we get more and more knowledge of people's risk, perhaps sometimes more knowledge about their risk and intentions than they have themselves, to what extent does that put at risk the core model of this social contract?
I don't think it does, but it certainly raises some interesting questions about how we define the term fairness. I'll explain. Mm-hmm. So let's say there's 1 million people whose premiums I'm pooling, because insurance at its core is a certain loss today in order to cover a contingent loss in the future. Now, if I only collect 20 data points, that 1 million people will all look pretty similar one to another. Whereas if I'm collecting 2,000 data points, I'll be able to, rather than see each person just an outline, I'll be able to see them in much higher resolution, and we'll be able to do a better job of charging them a rate that is commensurate with the risk that they're introducing to the pool. The precision with which I'm pricing increases exponentially. And therefore, rather than charging you, if you're a responsible person and I don't identify you as that today, I'm charging you in order to subsidize the person next to you who may be quite reckless. And that's not really fair.